Yeah, so I hope everybody can hear me. Do let me know in the chat if you're not able to hear the audio so that we can fix it. Yeah, so once again, hello everybody. Thank you for taking the time out to attend another Trublo webinar, which is our pure large cap product. So today we're going to be talking about the current state and the future outlook of the Indian IT sector, focusing mainly on the tier one companies or the large caps. So we all know that the Indian IT sector has been like a shining light for India and one of the first industries to become globally competitive. In the year 2000, the quantum of services exports was close to $5 billion, and in 2022, and right now in 2023, it's expected to have been above 170 to $175 billion, which is close to a 30x jump. To a 30x jump. So this was the beginning of the rise of the offshore model. So growth rates were very high at the turn of the century, and you can see it on the chart on the left. Growth rates were, roughly between 30 to 40%, and but this substantially reduced post the global financial crisis, which acted like a turning point. And global growth kind of stalled between 2013 and 2016 because there were a lot of visa issues at this point in time, and this was kind of the years when cloud migration really accelerated, and as a software products also accelerated, and revenues relating to infrastructure management services reduced. So the growth stagnated in the past decade. And between 2010 to 2020, in the last decade, IT services exports grew at roughly at 10%, whereas ER&D exports grew at a higher rate at 13%. So just checking once before I continue that everyone gets okay, sure. Right. So pre-COVID, this is the revenue growth for the tier one IT players. And pre-COVID, between 2017 and 2018, the sector saw really subdued growth due to visa issues and, like I previously mentioned, the rise of cloud and SaaS, and so on. But cloud migration, ERP modernization saw strong growth, which kind of nullified this decline, and many mega deals were won in this sector. So growth was kind of middling between 2017 to 2020. And post-COVID, there was a stark increase in demand for technology, and companies from all industries had to become were forced to become digital first. And the IT sector saw really strong growth in 22 and 23. So of course, after that, because of the staggering rise in interest rates, one of the highest in history, from 0 to 5% in to 15 months, a lot of companies started cutting back on spends, and IT sector was also hit. And there's a lot of discretionary spends which were cut back, and FY24 was pretty bad, or it saw moderate. Most companies saw moderation in growth, so revenue growth decelerated to mid to low to mid single digits in FY24. And this is so numbers have been very volatile due to COVID. So just smoothing the numbers out. This is the rolling 3 year revenue growth for all the tier one players over the past 10 years. And on average, growth for the industry has been in low double digits of over every rolling 3 year period. And you can see that the green line, which is Infosys, they have really they have accelerated in growth over the past few years. And this was actually after the new CEO was introduced. Mr. Salil Parekh really focused on growth at the expense of margins, but he has been successful in re-accelerating the growth engine in Infosys. Um, However, while all the other companies have been performing relatively the same, uh, Wipro and Techcom have been really underperforming their peers, and you can see that clearly in the chart. Looking at the headcount growth, which is a leading indicator of revenues, at least directionally. So, on average, uh, over the past decade, there's been roughly a 60,000 a net addition in employees uh, over the past decade. But for the first time in a decade, there was a reduction in or decline in the number of employees or growth in employees in the sector in 2024. And the number of employees in the IT sector reduced by close to 60,000. And this was roughly a delta of 1.2 lakhs. So the stress on the sector in FY24 is clearly visible, just if you look at the employee addition or the headcount addition. And even if you take a look at the headcount addition across the tier one space, roughly the headcount has been flat over the past 3 years, which is reflective of the weakness in the sector. And even if you take a look at, so if you take a look at the H1 employee addition, certain companies have started adding employees or adding headcount, and you can see that Tech Mahindra, LTI Mindtree, and have been uh, uh, TCS have been increasing the number of employees or adding headcount. But other players like Infosys, Wipro, or HCL Tech have been they have not really added anyone. So it's a bit of certain. It's very company specific, but there are certain initial signs of green shoot or acceleration or positive trends in the industry. But we need to wait and see over the next few quarters how it plays out. And just taking a look at the geographical mix of revenues. Um, so the roughly North America is a key market for all IT companies. Of course, it's the biggest market in the world as well. So roughly 60% of revenues come from all across companies come from the North American market. EU contributes to roughly 30% of revenues. So North America and EU, the developed economies, contribute to 90% of revenues of the IT sector. And if you look at growth from these two developed markets, whether it's US or Europe, they have been pretty dull over the past 12 months, 12 to 18 months. So you can see on the left that uh, growth uh, in the US has been close to zero, and Europe has seen some acceleration in the past quarter, but it's still very low at 5%. However, on the other hand, the rest of the world markets have really shown strong growth, whether it's in Asia, Middle East, and so on, even in India. So they have really seen strong growth, but their contribution to the IT sector's revenues is only in between 5 to 10%. So they don't really move the needle for these companies at the moment. Um, but so if you take a look at company specific geo growth as well. Uh, you can see that TCS has done really well and has seen a big acceleration in Europe, whereas HCL Tech and LTI Mindtree have bucked the trend and perform well in North America due to certain client-specific deal wins, whereas Wipro have they have declined in all three regions. Yeah. So this is the vertical mix for all tier one IT players. And one thing which clearly stands out is that roughly 30% or one third of their revenues come from the BFSI sector for most of these companies except HCL Tech and Tech Mahindra. And the BFSI sector is extremely key for growth of these companies. And this is followed by either healthcare, manufacturing, the high tech or technology sectors. So you can see that Tech Mahindra is more, they're kind of unique in the sense that the communications division contributes to close to 40% of their overall revenue mix. And for HCL, it's kind of broad-based, where it's very diversified. And taking a look at the biggest sector, which is BFSI, you can see which contributes to over one third of most of these companies' revenues. You can see that growth in this sector has been very muted in BFSI. But there, it actually was contracting till December, till the Q3 of last year, and over the past few quarters, there has been some quarter-on-quarter growth, but it's still extremely low. And you can also see the growth in the other sectors, whether it's healthcare, which is also another big sector, which is not really growing. So it's been flat for the past year. There's a widespread slowdown, and even BFSI, which is the largest segment, is also slowing down. And this is just in charts, the other sectors. So retail and CPG is also, close to 0%. Healthcare is also, the growth is sharply decelerated, and even telecom is kind of in high single digits. So there is widespread slowdown across industries. And one thing which is actually kind of interesting to notice, yeah, even though BFSI seems to have been slowing down and not growing over the past year, if you take a look at the IT spends of the top US banks in their financial reports, they have actually been growing relatively well. Um, but the revenues for the tier one IT players is actually the growth in revenues rather is actually much lower than the growth in the tech spends of the top five US banks. So it seems like maybe there is some, and if you correlate this with a lot of news of GCCs being set up in India by most banks, it seems like tier one IT players are losing share to these kind of in-housing of tech spends by global banks and companies in other sectors as well. So this is the growth of the Indian IT sector as a whole over the past decade. And over the past decade, actually, the sector, they have gained, they have consistently outperformed global IT services exports, and Indian companies have gained market share from global peers. However, if you take a look at just the tier one companies, and you compare it with the growth rates project put out by Gartner for IT services, yeah, the tier one players have consistently underperformed the Gartner IT services spends over the past 7 years. So they are losing share to smaller companies and to it seems like that they're losing share to smaller companies and localized GCCs. So this is despite Indian companies as a whole or India as a whole gaining share. And even if you take a look at order wins. So the definition is kind of different for different players. So you cannot actually kind of compare the order wins which are put out by these companies. But for TCS, they disclose the entire order book, whereas Infosys only speaks about the large deal wins or greater than 50 million deal wins, whereas HCL only talks about the net new deal wins. So in FY24, whereas while revenue actually declined, there was pretty strong or healthy order bookings, especially by Infosys, and and actually in FY25 in the first two quarters, Infosys has done pretty reasonably well when compared to their guidance at the beginning of the year, and they've actually upgraded their guidance. So this is actually also a lead indicator you can for revenues as well. Um, but if you take a look at the order wins in the first two quarters, it has actually uh, decelerated drastically, and in all companies, in all tier one companies, have seen either a single digit decline or a double digit decline in order wins over the past in the last two quarters. And this is actually in contrast to Accenture, which reported results recently. They have seen high single digit to double digit growth in order wins over the past in the last quarter and over the past few quarters. So Accenture is actually executing much better than the tier one players, and seems like they are gaining share. And we saw that certain the order wins, the growth in order wins were really high for certain companies, and so on. But the revenue growth was kind of middling and in single digits. So this is just the revenue, or the revenue in the current the revenue for a current year divided by the opening order book. So it's not strictly comparable across players, because and not useful for predicting revenues, but it kind of gives directional color. And you can see actually that the revenue conversion from the order book is has weakened over the past over the past 8 years. So this means that smaller deals are not really renewing, and companies are more focused on large deal wins, and the tenure for these deals are also increasing, so which kind of leads to a reduced annual contract value. So you can see on the chart that the number for most of these companies has actually been reducing over the past 8 years. And this is actually the commentary from Cognizant's current CEO, CFO, Mr. Jatin Dalal. And broadly, what he's saying is that so what he says is that in current times, he says that there's a ramp down in existing business, and there is a lack of discretionary spends. So there's a volume is kind of reducing. So he says that large deal wins is actually necessary or required for all companies, just to ensure, just to plug in the gap, or plug in the reduction of to nullify the effect of the reduction in smaller deal wins, or a reduction in discretionary spends. So this is the leaky bucket which he kind of talks about. So so this is why even though there's a lot of large deal wins, these companies are not seeing strong growth, because a lot of smaller deals are not happening, and there's a huge slowdown in discretionary spends. So when this kind of potentially accelerates in the future, that's when this industry will again start seeing healthy growth. And even if you take a look at the net client addition over the past few years, so if you just look at Infosys in the bottom corner, uh, you can see that if you take a look at the $100 million bucket, Infosys won a lot of mega deals from 2018 onwards, as post the entry of the new CEO. And But over the past 1 or 2 years, they haven't really won a mega deal or a large deal per se. But in the current year, they have been reasonably good at adding clients. Whereas HCL has not been as successful in winning mega deals over the past 7 years. But they did win a massive $2 billion deal with Verizon last year. And TCS have been probably the standout. They have been consistent in adding clients across categories, and they even won a massive deal with BSNL last year, which is really contributing to their growth over the past few quarters. And Wipro, on the other hand, they have their sales team have not really done well. They have been losing clients, and in the current year, I think it has been the strategy of the new CEO to let go of certain clients which are not profitable, leading to a decline in net client addition. So client addition also has been kind of decelerating for these companies. And if you take a look at moving on from revenue to margins over the past decade, EBIT margins, if you see at the beginning of the at 20 in 2014, EBIT margins for Infosys were close to 25 to 26%, and it is reduced to 21% at the moment. And even the same is the story for all these companies. They have seen a reduction in margins over the past 10 years. However, TCS is probably the the most consistent player. And one thing important to note is that in this time period, the USD INR USD INR rate has actually depreciated by close to 40% at the moment. But what actually happens is, while in the interim there might be margin levers because of this currency depreciation, uh, most such costs, there are a lot of cost saving clauses which are baked into the pricing, and these benefits actually have to be passed on by the IT services players. So these companies actually risk a cut in fees if these savings are not achieved, or the cost saving clauses are not achieved. So uh, as per the industry analysts, they say that committed cost saving clauses in deal agreements have actually climbed to 50 to 60% presently versus 20% over the last decade. So while many people kind of say that the dollar depreciation or might is will improve margins, while that may be true for a few quarters, over the longer term it's not true, and you can clearly see evidence of that. And just comparing the margins of two players, say in TCS and Infosys. So the gross margins of TCS is close, have steadily reduced over the past decade. So it's um, it's come down, from 40% to 35%. And if you take a look at the employee expenses over the past few years, so you can see that employee costs have from 54%, it actually increased to 58% in FY24. And these are actually some of the margin levers which the company is working on to improve margins going forward. And even if you take a look at subcontracting expenses, from 5 to 6% at the beginning of the decade, it increased to 9% in FY23, and that actually reduced to 6% in FY24, and which led to an improvement in margins as well. However, if you take a look at Infosys, on the other hand, their gross margins are 4 to 5 percentage points lower than TCS, and this is mainly due to their employee plus subcontracting expenses. And of course, because of their focus on growth, they were they were willing to see a reduction in their margins. So broadly, the difference in margins between these two players is mainly on the employee expense, and so this is also maybe potentially explained by the employee pyramid. And you can see that TCS has more junior employees when compared to Infosys. So Infosys has a lot of has a higher mix of senior employees as well. This is as disclosed in their annual report. So could also be one of the reasons for the change for the divergence in the employee costs. And if you take a look at attrition over the past 7 years, so right now, while attrition was a concern in the last few years, post-COVID, attrition is actually back to pre-COVID levels, and in H1 FY25, it's further reduced. So the fight for talent has kind of reduced, and this is a potential positive for the margins. So TCS attrition, the attrition for all companies is extremely low now, and probably one of the lowest, close to pre-COVID lows. So you can see consistently that TCS, their attrition has been low throughout the 7 years. In a business which is mainly about managing people, this is a clear leadership sign. And even if you take a look at utilizations, so the utilizations of employees are pretty high for most players at the moment. It is close to their 5-year peak. except for emphasis. So, but for most tier one players, it's close to their 5-year peak. So there's not significant headroom to improve utilization and to increase margins. So it is likely that employee additions by the tier one players will start accelerating in the near future if they want, if they in the near future, because they need to hire people to grow. Um, so just looking at the PAT growth, so there is the rolling 3-year PAT growth over the past decade. You can broadly see that in FY24, the rolling 3-year, so roughly they have been growing in high single digits. The PAT has been growing in high single digits, around 9 to 10%. They did see three spike during COVID, when PAT growth really shot up, especially for Infosys, which did like extraordinarily well during that period. But on average, PAT has been growing at close to 9 to 10%. And in this period, since 2018, when the valuations were, the IT's index was really close to a bottom. So the payout ratio for these companies also saw a massive increase. And most of these companies have started paying out close to 100% of their EPS or their free cash flow. So this has also led to an increase in their returns on invested capital, excluding cash, and led to a re-rating in their multiples as well. So this is just the implied or multiple on a Gordon growth model. So you in the previous chart, you can see that roughly the ROICs for most of these companies were close to 30, 40 to 50% technically. And we spoke about how they were growing at 9 to 10%. And at a 9 to 10%, the justified or implied PE you could potentially give to these companies is between 26, 25 to 28 times, or 25 to 30 times. So and right now, if you take a look at the valuations for the Nifty IT index, it is close to the decadal high, and yeah, especially on a trailing multiple. So it's in the top quartile over the past decade. Um, a- And even if you take a look at relative valuations, it's trading at a significant premium to the Nifty itself, and trading at above 2 times standard deviation over the of the past 10 years. And even if you take a look at the forward PE, so its forward PE is close to 30 times. So it seems like the index as a whole is trading close to their fair value, and you have to be really company specific going forward to make good returns in the future. And this is just a chart showing uh, the price movement year to date. So you can see that the IT index has actually significantly outperformed the Nifty in the current calendar year. So they have grown at the prices moved by 25%, close to 25%, excluding yesterday's move. But when compared to 8.5% for the Nifty, and if you take into, this is actually just the price return. So if you take into account the capital returns or the dividend payouts or slash the buybacks, it will be slightly more as well. So this is the outlook given projected by Gartner for FY 2025. So this was their updated outlook in October. At the beginning of the year, their 2024 growth outlook was close to 10.2%. But in last month, they actually halved the growth outlook for FY24, because there was no bounce back in the industry, in the growth in the industry as it was expected. So they've cut the FY24 growth estimate to 5.6%. And for the next calendar year, they're projecting an IT services growth of close to 10%. So they expect an acceleration in growth, especially probably due to macro factors like reduction in interest rates and so on. So, but we need to wait and see how it plays out. While there are some green shoots or positives which are being stated by the companies themselves. And if you take a longer term projection, So actually, before that, Gartner themselves are predicting that there will be a high single-digit growth, roughly at 8% till 2028. So they predict that the entire IT spending will cross $7 trillion by 2028. And if you even McKinsey is predicting that IT services as a sector will probably grow at 7% CAGR till 2027, and ER&D will, which is a subsegment, will probably grow at between 10 to 12% over the next few years till 2027. So this is also a chart, which is a pretty kind. This is a chart showing the IT sector's growth correlation with the S&P 500, and the correlation is S&P 500 revenue growth, and the correlation is actually really high. It's above 90%. So this is something we should probably be monitoring going forward. There have been a lot of earnings estimate cuts in the S&P 500 for the next 12 to 15 months. So. And there is a new administration which is coming in the US, so we need to be look at what happens, what changes in policy take place, and so on. Probably a major worry or something which is commonly spoken about is what happens to the IT companies, because if immigration is tightened in the US, because they did face some pressure in the previous Trump administration. But you can see here that these companies have actually reduced their reliance on the H-1B visas by almost half. So it's it it even if there is a lot of stricter immigration control, it doesn't seem like there will be a big impact on the tier one IT players, especially because they have also improve their onshoring and nearshoring practices. So it shouldn't really impact them. So broadly, the conclusion is right now, the tier one, the Nifty IT index and the tier one players have really re-rated over the past year, especially in the past 6 months, because of expectation of improvement in revenue growth, especially in the BFSI sector because of a reduction in interest rates. So they have, these most of these stocks are pricing in the best possible outcome over the next 12 to 15 months. So you need to take a company specific call, and if there are earnings cuts which happen, if there are a few quarters which do not grow, if they do not perform as well as what is expected, then it is likely that there will be some moderation in stock prices as well. So because BFSI, even though the interest rates have really reduced in the past year, the BFSI growth for the sector has not been pretty strong, has not been strong. And even in Accenture's latest earnings call, which happened a few days ago, they are talking. The CEO was stating that there has not been a change in the spending environment. So even the all indicators, there's no really strong positive indicator of growth over the next in the near term. So with that in mind, we get to the end of the webinar today. So uh, I'm happy to take any questions which you have. If you have any questions, you can just mention that in the chat box below. Yeah, so the first question is whether it's good to stay invested in the IT sector for long term. Yeah, I mean, definitely it's one of the highest. This is a sector with high quality of corporate governance, high low reinvestment needs, and a sector which is estimated to grow in mid to high single digits. Definitely, you need to it's a good sector for the long term, but you should not, probably at the current time you should be, very stock specific and not be overexposed to a sector, because there could be uh, maybe some underperformance in the near term. Has the stock, second question is, have the stocks peaked out? Will IT and underperform calendar year 2025? Uh, so of course it's very hard to predict what will happen to the stocks, but historically, at least, for we did see that, these the fair valuations for these companies are probably between 25 to 30 times. So we you need to probably wait and see what the commentary is from the Indian IT companies going forward, especially in Q3 and Q4, and how the budgets for the next financial year shape up, and reassess at that point in time. Because at the current juncture, there is no evidence, from, no for given provided by any company, that there is going to be a revival or a strong revival in growth. And if there is no strong revival in growth, the current valuations are not probably, are probably fair valuations or peak valuations. So uh, but we need to take incremental, so data could change, so we need to wait for a few quarters and reassess our opinion then. So but at the moment, uh, it seems like the valuation, strong growth is not on the anvil. So there's a question about how AI ML helping IT companies in growth and margins. So of course, all these companies have come out and stated that uh, like tools, LLM tools and so on have improved employee productivity by 25 to 30%. I mean, it's still very early stages. There are most of the clients are only undertaking proof of concept, doing POCs in AI projects or Gen AI projects. So uh, it could potentially improve gross margins in the future, but uh, the question arises whether the clients will want benefits from these, if IT companies are able to find improve, are able to find leeway in margins, or able to reduce their cost of service. So it is potentially good, but it may also lead to pricing pressure. So it's early days to comment on how it will evolve, but of course it could lead, there could be some revenue opportunity in the near term. So what could be the growth rate for TCS, Infosys, HCL? Recent years have been very flat. Yeah, so I think it seems like they would be growing at what they were growing in the past, probably close to mid single digits organically, mid to high single digits organically, uh, barring for acquisitions. So HCL have made an acquisition of, they've carved out certain, done a carve out of HP Enterprise assets, which will be consolidated with the company from Q3 onwards. So, but organically, even looking at the deal flow, which has been benign in the first half of the year, it does seem like growing faster than mid to high single digits is a stretch for the sector itself. Uh, there's another question about whether IT companies risk cannibalizing their existing contracts due to Gen AI. I don't know if about cannibalization, but I mean, there could be pricing pressures if if they if but we need to wait. It's still early stages, like I mentioned. At the moment, there is it at the moment it's not really affecting their business models, but going forward, certain areas, maybe like software testing, could potentially be automated completely. It's not like automation was not part of these, was not existing prior to this, but uh, yeah, it's still early stages, but yeah, it is a potential threat to the revenues or pricing. But on the other hand, the flip side, even the employee productivity could drastically increase. So yeah, we need to wait and see how it impacts the sector. Whether tier two companies are in better position than tier one players. Actually, at the moment, I mean, yeah, tier two companies have performed extraordinarily well over the past few years, and they have been they are growing at in the mid to high teens, but again, you need to be very stock specific there, because the valuations there are extraordinarily high. So it's trading at a huge premium to even to the tier one players for good reasons because they are growing at a much faster pace. But you need to be, it's yeah, very stock specific. So, uh, strategy on doing SIP from 2019 when it was down, now at peak in valuation on this, what is the strategy? Uh, I mean, if you're doing an SIP, I think the concept of a systematic plan is to invest across market cycles, whether it is up or down. So if you're doing an SIP already in an IT sector, I mean, even though the valuations are probably high, there could be some, acceleration in revenues going forward. So we need to wait and see. So it doesn't make sense to stop a systematic plan, especially such a long-term plan, since you're saying that you've been doing it from 2019 at the moment. When there's a peak and trough in valuation, that is when you should actually probably do a lump sum in these indices. But right now, definitely is probably not the right time to do make a lump sum investment in the IT index. So yeah, IT stocks valuation is fair now. Yeah, definitely it seems like that, especially for the growth. If there is evidence, super strong deal wins over the next few quarters, or the deal environment changes, environment changes in the next few quarters, which will enable these companies to grow at double digits. Then we can take, we then these stocks should probably be reassessed at that point in time. But right now, for a mid to high single digit growth industry, it does not. Yeah, the valuations are pretty reasonable, I would say. Will this presentation be available in YouTube? Yeah, this presentation will be available on our YouTube channel at ithought.pms. Uh, what about Tech Mahindra's growth? Growth looks like valuation is at its peak. So yeah, Tech Mahindra, the story there is more on margins. So with the new CEO, the CEO has laid down a strategy for future growth. So he wants to outperform the IT index, and he wants to improve their margins. So their EBIT margins right now are kind of abysmal, and it's probably they do have a vision or a clear sight of vision for growing their EBIT margins to 14 to 15% over the next few years. But yeah, so of course the valuations for all these companies are kind of they're definitely not undervalued at least. So yeah, so value you need they are most of these companies are fairly valued. So book recommendation for understanding about investments. I mean, there are a lot of books, so it's a bit hard to recommend one. But probably you could start with books by Peter Lynch and Julian Blatt. Specifically on the IT sector, books on IT sector, I mean, there are a lot of books on, which are focused on companies and talk about, their biographies of those companies, whether it's TCS, Infosys, or any tier two players. So you could read those books to understand about how the company evolved, how the industry evolved, and so on. And you could also see there are a lot of long form interviews on YouTube with the founders of these companies, and watching those interviews would give you a reasonable idea of how a sense about the culture of those companies as well. Yeah, so there's also another Q question on how do you see non-Indian IT companies, especially Cognizant, as they trade lower at lower multiples compared to the Indian IT sector? Yeah, this is a fair question because I think Cognizant trades at a pretty steep discount to the tier one players. But I mean, on the other flip side, Accenture trades similar close to where TCS is trading at, despite a stronger execution over the past few years. So Cognizant, I think, has historically underperformed, and in the past, especially in the past 5 to 7 years, and they have lost significant market share too. Indian IT players, and that's what led to an Indian IT CEO and CFO combination, leading the change at Cognizant right now. They have also done a massive acquisition of Belcan recently, and they're trying to change. They're trying to do a turnaround at Cognizant. I mean, it's still early days because the new CEO and CFO have only joined earlier this year. We need to wait and see if there are initial positive signs in Cognizant on the performance, on margins and deal wins. But yeah, it's still early days to conclude. But definitely they do trade at lower multiples, but probably for justified reasons because they have been losing market share, losing clients over the past 3 to 5 years. So I think if there are no other questions, we can. Okay, there's one more question. So are mid-cap companies in a bubble like KPIT? Uh, so these companies have been, growing really strong. They've been growing at above 20, high teens or even 20% plus over the past few years with margins expanding. So, I mean, whenever most of these companies, if they're trading at premiums, probably for a reason. So, but if you're an incremental investor, what you need to question or answer for yourself is whether these companies will continue to grow at 18 to 20% over the next 3 to 5 years. If you're really confident of that they're going to grow at that rate, and even at after 5 years there is potential for them to grow at double digits, then maybe valuations could be justified. But of course the ask from the management and from the company is pretty steep. So yeah, you need to be very careful in the mid cap IT space going forward. But certain companies could definitely execute really well like they have done in the past and outperform. So yeah. Yeah, thank you everybody. I think if there are no other questions, we can wrap up. Thank you for taking the time out to join us today, and hope it was insightful for everyone. Yeah, thank you everybody.